PSG paid 222 million euros for Neymar in 2017. 7 years later, he left for free. They got back exactly zero. How does a $250 million asset just vanish? Because football players aren't just athletes, they're traded assets, and the market prices them exactly the way the stock market prices a company, with one brutal difference. When a club buys a player, it's buying the player's registration rights, the contract. Under international accounting standards, that contract is an intangible asset, like a patent. It sits on the club's balance sheet and gets written down over the contract length. That's called amortization. The player is literally an asset in the accounts. So what drives the price? Simple. How good they are, how long they'll stay good, how long you control them, and how much money they can generate. But here's where it gets interesting. A transfer fee is a bet on future performance and future resale. The exact same logic as valuing a stock. A stock's price reflects expected future earnings. A player's fee reflects expected future performance and resale. Both are bets on tomorrow, not rewards for yesterday. Academics at CIES Football Observatory built models on over 8,000 transfers. Their conclusion? The market is about 85% predictable. Fees aren't irrational. They follow comparables, just like stocks. Clubs price a player off peers with similar age, performance, and contract length, exactly like analysts use PE ratios and comparables to price a company. But the analogy breaks in 3 critical ways. First, a player is a depreciating asset. They peak around 25 to 27, then decline. A company can grow forever. Second, injury can take the value to zero overnight. One ACL tear and a 100 million euro asset is worth almost nothing. There's no corporate equivalent. Third, at contract end, the player walks away for free. It's like a bond maturing. The asset simply expires. You can't hold it forever. So clubs are racing against 3 clocks: age, injury, and the contract running down. Miss the timing, and the value evaporates. Now let's see the math in action. A club buys a player for £50 million on a 5-year contract. Straight line amortization. £50 million divided by 5 equals £10 million per year as a cost. After 2 years, cumulative amortization is £20 million. So the book value, what's left on the balance sheet, is £30 million. That's the number that matters for accounting. If the club sells him in year 3 for £40 million, the accounting profit is £40 million minus £30 million book value. That's a £10 million profit on paper. Even though fans see a £10 million loss versus the £50 million paid, the accounts see a profit. Profit and loss in football are measured against book value, not the original fee. Real example, Harry Maguire. Manchester United paid £80 million on a 6-year deal. That's £13.3 million per year amortized. Long contracts shrink the annual hit. Accounting magic. Chelsea took this to the extreme. Enzo Fernandez, £106.8 million on 8.5 years. That's about £13.4 million per year. Spread it long enough and even huge fees look manageable annually. UEFA and the Premier League caught on. From 2023, they capped amortization at 5 years, the so-called Chelsea loophole closure. You can't game the system forever. Now here's the part most fans misprice. Contract length is leverage. A player with 3 years left is worth far more than the same player with 1 year left. Why? Because in 1995, the Bosman ruling made out-of-contract players free agents. If the contract runs down to 0, the club gets nothing. The asset expires. Academics find each extra year of contract adds roughly £550,000 to £800,000 to the fee. Contract length is price leverage, not just talent. Paul Pogba. United let him leave for free in 2012. Out of contract, barely £800,000 in training compensation. 4 years later, they bought him back for €105 million. Juventus pocketed around €72 million profit and paid the agent €27 million. United paid a world record for their own academy graduate because they lost contract control. Brutal. Fast forward to 2024. Kylian Mbappe. PSG paid 180 million euros for him in 2017. He ran down his contract and left for Real Madrid. Transfer fee? 0. But Real gave him a signing bonus around 150 million euros. The money didn't disappear, it just moved from the selling club to the player, like a bond maturing. So contract control is the single most underrated lever. Clubs extend contracts partly to protect asset value and partly to reduce annual amortization cost. It's financial engineering. One more wrinkle: academy players. A homegrown graduate has a book value of 0, no purchase price. Sell him for £40 million, and the entire £40 million is profit. Compare that to a £60 million signing sold for £75 million after 2 years. Book value about £36 million on a 5-year deal, so roughly £39 million profit. Academy wins on cost basis. This is why clubs sell beloved academy graduates every June. Pure profit to comply with financial regulations. Cost basis drives return, exactly like buying a stock cheap. Now let's talk about the traps. Clubs make the same behavioral mistakes investors do, and the consequences are just as expensive. First, FOMO and bidding wars. Multiple rich clubs chase one player, and the price inflates, just like a hot IPO. The winner often overpays. It's called winner's curse, and football is full of it. Second, recency bias. ESPN's verdict: the worst time to buy a player is immediately after a strong World Cup. Small sample, high price, exhausted player. But clubs do it anyway. Third, anchoring. Neymar's 222 million euros set a psychological anchor. Sellers refuse to go below what they paid, even when the player has declined. The old price haunts every negotiation. Fourth, loss aversion. Clubs hold declining, expensive players too long rather than crystallize a loss. The football version of refusing to sell a losing stock. Sunk cost fallacy. And fifth, overconfidence. Barcelona thought they could unlock Coutinho. They paid around 135 euros to 160 million euros. He never fit, eventually sold for about 20 million euros. Classic value trap. But Liverpool were the real winners. They reinvested the fee in Van Dijk and Alisson, turned it into a Champions League title. Seller timing is half the battle. Some clubs figured this out. Brentford and Brighton run squads like trading portfolios. Buy undervalued players cheap, develop them, sell high. It's Moneyball for football. Brentford spent about £75 million total and recouped over £190 million in sales. Watkins bought for £1.8 million, sold for about £28 million. Value investing, not luck. One last misconception. Shirt sales pay for transfers. Clubs keep only about 7.5 to 15% of shirt revenue. Daniel Geey calculated United would need 8.9 million extra shirts to recoup Pogba's fee. Ronaldo to Juventus did boost shirt sales and social reach, around 520,000 shirts in 24 hours. But the commercial case is supplementary, not the main driver. Performance matters most. One more data point. Those market values you see on Transfer Market? Crowdsourced estimates from volunteers. Not audited, not official. Treat them like stock price targets. Opinions, not facts. The only reliable numbers are club balance sheet figures, book value, amortization. Everything else is a model, a guess, or a negotiation. Know which you're looking at. So what does all this teach you about money? First, price equals expectations about the future, in football and in markets. What you pay today is a bet on tomorrow. Second, control and time horizon set value as much as quality. Years left on a contract, years you plan to hold an investment. Both change what it's worth to you. Third, cost basis drives return. The academy player and the cheaply bought stock win because they started near zero, not because they're inherently better. Entry price matters. Fourth, estimates are not facts. Market values and price targets are opinions. Audited book value and real cash flows are facts. Know which column you're reading. Fifth, the crowd overpays after good news and holds too long after bad news. Recency bias, anchoring, FOMO, loss aversion. They cost clubs and investors the same way. And sixth, some assets depreciate and can go to zero. Footballers age and get injured. Bonds mature. Leases expire. Not everything compounds forever. Match your mental model to the asset. Here's the bottom line. Whether you're buying a player or buying a stock, you're buying a claim on future value, discounted by time, risk, and control. The clubs that win are the ones who see the asset clearly. The age curve, the contract clock, the cost basis, the crowd's blind spots. And then they act before the window closes. The same rules apply to your money. Understand the asset, time your entry, watch the expiration date, and don't let the crowd set your price. Thanks for watching. See you next time.